I'll allow you to unmute. Okay. For now, I am mute. Academic team, still I am not the host. Make me co-host, no? Because I need to manage these people. They'll write on my board also. I'll have to manage annotations. When we are ready to go live, tell me, then I'll start. So shall I start? Hi friends, very good morning all of you. Welcome to CA final financial reporting classes. So it is a matter of immense pleasure and honor for me. I am delighted, with in the association of Kew Academy Chennai, we are doing this CA final financial reporting regular live classes with recorded backup. So the lecture plan will be something like 120 plus hours, which covers 100% of the syllabus in the curriculum of CA final ICAI. So my name is Pavan Kumar. I am a chartered accountant and a resource person in this financial reporting audit subjects. So today we are going to start with the introductions. We'll start with certain kind of basics, and as you know, at CA final level, the level expected is expert level. The level of knowledge expected is expert level. So I'll take you through all the basic levels, mediocre level, and then we'll touch the final level. Okay, so once again, good morning all of you. I am welcoming all of you to this CA final financial reporting classes. In association with Kew Academy Chennai, we are starting this CA final financial reporting paper. My name is Pavan Kumar. I am a resource person in the subject of financial reporting and also advanced auditing and professional ethics. So today we are starting with our introduction class, and this is lecture 1, session 1. Okay, so as you know, in chartered accountancy course, there are basically 3 levels. First level is foundation level, second level is intermediate level, and third level is final level. If you have read the content of ICAI properly, ICAI properly, clearly said, explicitly said that the level of knowledge required for foundation is basic level. The level of knowledge required at CA intermediate level is working and application level, and the level of knowledge required to pass the CA final examination is expert level. So we are going to be, by the end of the session or by the end of the coaching, or when you write the exam and when you prepare your CA final exams, and when you pass your CA final exams, you will become expert in accounting. Obviously, a chartered accountant is an expert in accounting and auditing, no? Okay, so this is what is required from you. ICAI is expecting that you will become expert in all the domains, and especially accounts and audit are our lifeblood, and taxation, of course. Accounts, taxation, then audits. If you see whether you are employed or whether you are going to be in practice, these are inevitable areas. So both for your academic interest to pass CA final examinations, this session or this acquiring the knowledge in CA final is very important. And also in future, whatever your activity is going to be, whether you are going to be a member of ICAI in practice or a member of ICAI in service, this accounts is going to be a key maker and a key role player in our future. With this very small intro, can we start with the class? Yes, chalo. Okay. 1 second. Just 1 second. Just give me 1 second, guys. I'm interacting with your academic team regarding a small thing. So guys, have you seen the syllabus before? Okay, so we'll continue. Sorry for the interruption. Now we will not have any problem. Okay. So, guys, just I am sharing one document on the screen. This is taken from ICAI website only. Can you just read this, all of you? So this is basically the syllabus and weightage of financial reporting. This is the syllabus and weightage of financial reporting. So basically, if you read the syllabus of CA final financial reporting, there is nothing but Ind AS. So everywhere you see Ind AS, Ind AS, Ind AS, Ind AS. Other than that, you cannot see anything. And also, if you see the latest circular of ICAI, the notification they have given maybe few months before, not even it must be some 2 months, 3 months before. They have deleted all the accounting standards also from the syllabus. So now literally only Ind AS are there. So look here, there are 7 sections. Section 1 is having a weightage of 10% to 15% in the examination. Our exam is for 100 marks. So 10 to 15% means practically 10 to 15 marks. So what is the area? Framework for preparation and presentation of financial statements in accordance with Ind AS, which is purely theory. Then second one is application of Ind AS with reference to general purpose financial statements. What are general purpose financial statements? Balance sheet, P&L, cash flow statement, notes to accounts, statement of changes in equity. These are known as general purpose financial statements. So whenever you are preparing general purpose financial statements, you need to comply with Ind AS. Okay, so this is second one. Then Ind AS on first time adoption of Ind AS on presentation of items in the financial statements, Ind AS on measurement based on accounting policies. This is category 1. Then category 2, section 2, again another section with 10 to 15%, and it is Ind AS on income statement. Ind AS on income statement, like your revenue recognition, Ind AS 115. So how to recognize revenue from contracts with customers, that will come in second area, which is very important. 10 to 15% of weightage is given. Then the third one is also having a weightage of more weightage of 15 to 25%, and this is Ind AS on assets and liabilities of the financial statements, including industry specific Ind AS. Industry specific Ind AS are not that important or popular because general accounting standards are more to be applied. For example, consider inventory valuation. Inventory valuation is applicable across all the industries. But if you look at insurance contracts, there is one accounting standard exclusively for insurance contracts. Insurer. There is one accounting standard exclusively for exploration of mineral rights, etc. So these are industry specific standards. If you are into extraction, if you are extracting petroleum, or if you are dealing with oil and natural gases, if you are into mining, then one accounting standard is there for you. Agriculture is also industry based accounting standard. So you call it inventory valuation, you call it revenue recognition, you call it leasing, you call it property, plant and equipment, you call it intangible assets, you call it impairment loss. All these are in general applicable to all the industries. There are very few standards which are applicable to a specific industry. They are also there in the syllabus. So what are Ind AS on assets and liabilities? Simple. One, property, plant and equipment is an asset. Inventory is an asset. Investment property is an asset, like your old accounting standard 13. Okay, that is called here. Now we call it Ind AS 40. You understand? Then intangibles. Previously, you might have studied intangible assets in AS 26. Now we call it Ind AS 38. Previously, you might have studied property, plant and equipment AS 10. Now it is Ind AS 16. Previously, you might have studied accounting standard relating to revenue in AS 9. Now we call it 115. So all the asset liability related standards are given in one category, that is section 3, which is having 15 to 25% of weightage. Then comes the fourth category, Ind AS on items impacting financial statements, Ind AS on disclosure in financial statements, and other Ind AS. This is fourth category. And last one, other Ind AS means residuary category. Any Ind AS which is not falling in 1, 2, 3 category will fall in the fourth bucket. So that is also given 15 to 20%. Then comes the biggest challenge for any CA final student, that is in your old language, amalgamation and consolidation. So that amalgamation, it deals only with one category of transactions. Like, two companies are coming together, one company is taking over another company. But there is actually much more in business combinations. For example, demerger. So transactions like demerger were not covered in your accounting standard 14. But this business combination, when we are speaking about this Ind AS 103, is huge and wide, is huge. So it covers so many types of transactions. So that is the reason they call it business combinations, including restructuring. So this is one major area. You can expect 10 marks minimum from this. Another major area is consolidated financial statements. Okay, accounting for group entities we call consolidated financial statements. You might have studied consolidated financial statements in CA intermediate also. If you are from new syllabus, if you are a new syllabus student, you might have studied in your CA intermediate, consolidation is there. But let me tell you that consolidation is like playing cricket in your backyard of the house or in your street. That is street cricket. And this consolidation, what you are going to learn in CA final is international cricket. So there is a upscale, there is huge shift in the level of difficulty and the level of knowledge. And also the consolidation you learned in intermediate is as per accounting standard 21. But this is as per international standards, which is nothing but Ind AS. Okay, so that part is there, fifth part. And then sixth part, financial instruments, another major, issue in financial reporting, which almost shook the banks and financial institutions. The whole structure of the banks and financial institutions is shaken, I can say, because of this financial instruments. A very, very important topic, both with real life relevance and also, for CA final, 10 to 20 marks is expected from this financial instruments. So this also we'll see. There are 3 standards dealing with this, that 3 standards we'll see. Then the last one is, again, a miscellaneous kind of thing. 5 to 10% of weightage is given for analysis of financial statements, integrated reporting, corporate and social responsibility report. Corporate social responsibility. These 3 are petty, small topics. Okay. Majority theory. Maybe you will see problems also, but very limited, scope is there for problems. Major, it is theory. So this is your CA final syllabus. And they have given only side headings, okay. Ind AS on assets is what they have given. But when you enter what is Ind AS on assets, there can be, 100 things inside again. There can be so many standards inside again. So we will start today with one standard which already you are aware of, but what you are aware of is only one small particular level. We will take that to another dimension. So we'll see the advanced concepts also. So shall we start with accounting standard on property, plant and equipment? Shall we see accounting standard, property, plant and equipment? Okay, so this is ICAI study material I am sharing. So we'll deal with ICAI study material exhaustively. We'll cover everything in ICAI study material. Okay, I hope you have a soft copy of this. If you do not have a soft copy of this, I request you to download. So we'll start our first session with, Ind AS 16, property, plant and equipment. So if you read, any textbook, if you open any CA final textbook, sometimes it will be like this. Say for example, sometimes they say Ind AS 8. Sometimes they say Ind AS 108. Sometimes Ind AS 16, property, plant and equipment. Sometimes they say Ind AS 116. First, what this difference is. Now try to understand the process in which the accounting standards were developed. If you look at the process in which the accounting standards were developed, there is International Federation of Accounts Committee, International Accounting Standards Board. Okay, so International Financial Reporting Standards were developed globally by, like how we have regulatory authority in India by name ICAI, and ICAI has Accounting Standards Board, ASB. Globally, we have International Accounting Standards Board. Previously, it was International Accounting Standards Committee. Now, see, up to 2001, they are known with one name. After that, they are known with a different name. So, if you look at IFRS, there are two generations. One is IAS, International Accounting Standard. Second one is International Financial Reporting Standard. Pavan sir, is there any difference between the two? No, this is before 2002. IFRS is after 2002. That's it. But when IFRS, the board started releasing IFRS, the first sentence they said is all the international accounting standards, issued erstwhile are existing today. Everything will be relevant even after IFRS are issued. That means from today, they said in 2002, from today onwards we'll be issuing IFRS. But before that, Ind AS were there last 20-30 years. It is this IAS, International Accounting Standard. So they said we are not ridiculing or we are not expelling, we are not cancelling any of this IAS. This IAS also will continue. International Accounting Standards also will continue. Now, when India has taken a decision to globalize or to harmonize with global standards, we have decided our old accounting standards, we are going to scrap them and we are going to implement IFRS by issuing new generation accounting standards known as Ind AS. So Ind AS, I can say one thing, it is a replica of IFRS. I have done my IFRS from Ernst & Young. I have practical experience in, dealing with financial statements in compliance with IFRS, and also I have audited those financial statements. So I have, decent idea about this international financial reporting standards. And since I am CA final regular faculty, I have good idea about this Ind AS, and now as a practice in CA, I am looking at Ind AS financial statements as well in my regular life. So I can tell you more or less this IFRS and Ind AS, they are same. Few differences are there. Those differences are known as carve in, carve out. That we'll see later. So today, first day, I do not want to overburden you with the different wordings. Carve ins, carve outs, we'll see later. But IFRS and Ind AS are almost same with few differences. Now, how the numbering is given in Ind AS? Ind AS corresponding to IAS. Ind AS corresponding to IFRS. So if ICAI is developing one Ind AS which is a replica of erstwhile IAS, globally international accounting standard. Now we are developing that accounting standard in India, for example, inventory. So this is IAS 2. So it will become Ind AS 2 in India. But if you are preparing, say for example, there is IFRS 3, business combinations. If you are developing Ind AS in compliance with IFRS, this will become Ind AS 103. So 100 is added. So any Ind AS which is above 100, like 101, 102, or 108, 116, Ind AS 115, Ind AS 113. So any Ind AS which is having a number of more than 100, its corresponding parent document, the international parent, its international parent is IFRS. If I am developing one Ind AS where the original document in international, its international counterpart is IAS, International Accounting Standard, then the same name will come. The same names. That means 2 will become 2 only. You understand? That is the reason you need to understand one difference. Sometimes there is Ind AS 8. Sometimes there is Ind AS 108. So what is the difference? Ind AS 8 means below 100 it is International Accounting Standard. Above 100 it is IFRS. This is the backdrop. Not much relevant, for academic purpose, but you should understand the background also little. That is the reason I have done this. Okay, I have given you this brief introduction. Now let us start with property, plant and equipment. So open your notes. So guys, open your notes. Put the heading CA Final Financial Reporting. We are starting with Ind AS 16. What is this? Property, plant. What is this? Property, plant and equipment. Property, plant and equipment. Okay. So basically, what is property, plant and equipment? It is nothing but a tangible asset. Property, plant and equipment is nothing but a tangible asset. Okay. So you call it land and buildings, you call it plant and machinery, you call it furniture, fixtures. So if you look at the nomenclature, the title, there are 3 words. One is property, one is plant, one is equipment. You might have studied in this schedule 3 financial statements. In that also you might have used property, plant and equipment. This is international language which we started using from 2017. Before 2017, in India, we never used the word property, plant and equipment. We used to use the word fixed assets. That is the reason your accounting standard 10 originally was fixed assets. Then it has become AS 10 property, plant and equipment. Okay, so this includes all the tangible assets. This includes all the tangible assets. So we are going to learn everything in the accounting for tangible assets. Okay, now the Ind AS, that is property, plant and equipment accounting standard in the new generation is far above your old accounting standard. For example, I'll give you one small example so that you understand. So I want your participation also. My class is not going to be a one-way communication. You need to extensively participate. Now in this live class, I will ask some questions. In the chat box, you need to answer. In the chat box, you need to answer. Okay, develop the habit of responding more. If your answer is incorrect, doesn't matter. But participation is more important. Participation is more important. So look here, X Limited purchased a machine costing rupees 10 crores from Y Limited. What is this? X Limited purchased a machine costing rupees 10 crores from Y Limited. The payment terms are, the payment is to be made. The payment is to be made. The payment is to be made at the end of third year from the date of purchase. How the machine is to be recognized in the books of X Limited. This is the question. Very important question from exam point of view also. A teaser, a tidbit for you to think and to develop, this level of thinking. Point number one. Point number two, from exam point of view also, this is an important question. X Limited purchased a machine costing rupees 10 crores from Y Limited. The payment is to be made at the end of third year from the date of purchase. How the machine is to be recognized in books of X Limited. Okay, so I'm waiting for your answer. Can you tell me what is the journal entry? What is the amount with which the journal entry is to be passed in the books of X Limited? Okay, can you tell me the answer? I'm waiting for your answer in the chat box. So who's going to answer? Hey, so many students are there. No one is responding. Journal entry bolo, amount bolo. What is the journal entry you pass? Calculate the, Ritik is saying calculate the present value of, recognize that in the books. Nirmal is saying machine debit. Okay. Very good, Nirmal. Machine account debit. Then credit goes to Y Limited. Okay. So Nirmal is saying machine account debit to Y Limited. Very good. Any other answer? Gokul is saying property plant and equipment account debit to Y Limited. Okay, Shreyas is saying property plant and equipment account debit to Y Limited 10 crores. Okay, very good. I appreciate. What about others? Sumit is saying machine account debit. Okay, then to Y Limited. Very good. Machine account debit to Y Limited. What about others? Pragati is saying machine account debit. Machine account debit to Y Limited. Okay. So please tell the amount also. Kushi, Pragati, Sumit, your journal entry is correct. Can you tell me the amount also? Pragati is saying 10 crores. Okay. So very good. Majority of you have given the answer that the journal entry is property, plant and equipment. In brackets you can write machine if you want. Debit 10 to Y Limited, credit 10. This is the journal entry everybody said. This is absolutely right as per AS 10. But welcome to CA final. This is not a correct journal entry when you are a CA final student. Ding, 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 ding. Pavan sir, what makes the difference? What makes the difference? See, remember one basic rule. No asset can be recognized in the books of account with a value which is more than its fair value or recoverable value. For example, if I go to the same Y Limited, I asked him, boss, how much this machine is? He said 10 crores. Then I asked, what is the payment term? What is the payment term? He said 3 years. If I say I have enough cash, I will pay you with a single check today. Today I'll give you a check, but I'm not ready to pay 10 crores. 10 crores is too much for me. So what is the cash down price? So you are giving deferred credit to me. What is this? Deferred credit extended to 3 years, which is beyond normal credit period. Normally, who will give 3 years of credit period to you? Normal credit period can be 15 days, 30 days, 45 days. So this is extended credit period. I said, I do not want this extended credit period. If I pay you cash today, at what price you will give this machine to me? Then Y Limited said, 9 crores. Give 9 crore rupees, take this. Then logically, substance over form, logically, X Limited is paying 9 crore rupees towards procurement of that property, plant and equipment. For acquiring that property, plant and equipment, they are paying 9 crores. For this deferred period of 3 years is there, no? Deferred period of 3 years. For this deferred period of 3 years, they are paying 1 crore rupees as interest. Okay, now the question is that 1 crore rupees of interest, whatever I am paying, can I capitalize it? The answer is no. Why? Because the asset is put to use. You might ask, Pavan sir, borrowing cost is there, accounting standard 16 or Ind AS 23. According to borrowing cost, interest paid on machine can be added to the machine. Beta, yes, but not after the asset is put to use, no. Is this a qualifying asset which takes substantial period of time for its production or construction? No. This is a ready-to-use asset. So when it is a ready-to-use asset, how can you capitalize interest? So this 10 crore rupees should be broken into two parts. The fair value of the machine and the interest component. Fair value of the machine is to be capitalized. It will go to balance sheet. That interest component is there, no? We need to do something called unwinding. What is this? Unwinding. Amortization also we call. Unwinding of interest or amortization of interest. Okay. Then you will have to take that to your income statement, interest paid. Pavan sir, how do we calculate that, interest? Simple. 9 crores is present value. 10 crores is future value. After 3 years, because I'm paying it is 10 crores. Today, if I pay 9 crores, so this 9 crores is present value, 10 crores is future value. What is the rate of interest which equates 9 crores of present value with the 10 crores of future value? This is in your financial management IRR. In financial reporting, in accounting at CA final level, or when you are reading IFRS, we call it amortization rate. Nothing but interest rate, discount rate. Amortization rate. So you will use some amortization rate. Say for example, you got 4.35%. So you will use this IRR and you will calculate how this 9 crores is becoming 10 crores. In 3 years. This is year 1, this is year 2, this is year 3. Then 9 crores is becoming 10 crores. No? So you will calculate here X rupees, here Y rupees, here Z rupees. X plus Y plus Z put together will be 1 crore. So this X rupees you will take to P&L in first year. Y rupees you will take to P&L in second year. Z rupees you will take to P&L in third year. You understand? That is how we have to record. Now, property, plant and equipment will not be recorded at 10 crores. All of you said, Pavan sir, machinery account debit to Y Limited account 10 crores. No, machinery account debit to Y Limited 9 crores only. So what is the accounting principle here? The accounting principle here is an item of property, plant and equipment is an item of property, plant and equipment is recognized in the books of account on the date of acquisition at its fair value or the cash down price, equivalent cash down price, if there is any deferred credit period beyond the normal credit period. If you are extending normal credit period to me, Pavan, purchase this machine, pay me within 1 month. Okay, normal transaction. But if you say, Pavan, you can buy machine from me, you can pay money after 3 years. That means I have to understand you are not only selling the machine, you are financing my machine also. So you expect consideration towards the sale of machine and consideration for giving that 3 years of finance. You understand? This principle, whatever I told you one principle now, no? Deferred credit terms. This is applicable for property, plant and equipment. This is applicable for intangible assets, and this is applicable for inventory also. For inventory also, this is applicable. You understand? These are the basic changes from normal accounting standards to Ind AS. Substance over form. Previously, calculation of fair values, present value, future value, these kind of things were not there in Indian accounting. In Indian accounting, we never used present value, future value. In accounting, in finance, we use. For the first time, because of this Ind AS, we started using all these concepts in India. Okay, so shall we see one problem on this? I do not want to overburden you with too much of theory. I will explain all the theoretical concepts also. At the same time, we'll do some problems also so that it will become some warm-up exercise for you and you will not be bored. You will not be bored. So we'll do one problem and then we go back. Okay. This is the problem, deferred payment credit. Okay, this is going to be our problem number 1 in this batch, the first problem we are seeing. So before that, let us try to read the principle and understand what it is. So read the para. The cost, what is the situation? Payment deferred beyond normal credit terms. Payment deferred beyond normal credit terms. The cost of an item of property, plant and equipment is the cash price equivalent. What is this? It is cash price equivalent. On the date of recognition, at the recognition date, whatever the cash price equivalent is, that should be capitalized as an asset. If payment is deferred beyond normal credit terms, the difference between the cash price equivalent and the total payment is recognized as interest over the period. Interest over the period of credit. However, if the asset is a qualifying asset, if the interest can be capitalized as per your old accounting standard 16, now we call it Ind AS 23, BC, borrowing cost. So as per your Ind AS 23, if it can be capitalized, that is a different issue that we will not see here. Here, what do we see? Normal credit period given, normal journal entry. Beyond normal credit period is given. Then we calculate cash price equivalent. This is the principle. Based on this principle, they have given illustration. First question. Okay. So shall we see this question? On 1st April 2011, an item of property is offered for sale at 10 million, with payment terms being 3 equal installments of 33,33,333 over a 2-year period. Payments are made on 1st April 2011. That means today you paid one installment. Today you bought 1/4/2011, you bought the asset. 1/4/2011 itself you paid 333. Okay, and second installment is paid on 31st March 2012. Third installment is paid on 31st March 2013. Implicit rate of interest. Have you heard this anywhere? Do you remember using this implicit rate of interest in your CA intermediate in advanced accounting standard 19? You remember leases. In the leases, when you are doing, accounting for finance lease in the books of lessee, then you used one rate. What is that rate? Implicit rate of interest. What is implicit rate of interest as per accounting standard 19? Which is nothing but the IRR from lessor perspective. Same here. It is also IRR. Implicit rate of interest is nothing but IRR. So 5.36% per annum. Show how the property will be recorded in accordance with Ind AS 16. can you take 1 minute of time? I will not give you more time. Can you take 1 minute of time? Calculate the cash equivalent price of the machine and tell me. Calculate the cash equivalent price of the machine and tell me. Can you do the working? Please do it fast. So I want answer from you. Not a difficult thing, okay? Simple thing. If it is difficult thing, I will not ask you. I am still waiting for your answer. Sir, 1 minute is not over, sir. Please sit happily, quietly, sir. Okay. You calculate it. Take your calculator. I got my answer. You are still not ready with the answer. So anyone who got 95 lakhs approx as answer? Gaurav is saying 95 lakhs. Very good, Gaurav. Correct answer. Anyone else who got 95 lakhs? Anyone who got 95 lakhs? Only one student. Come on here. Okay. Write down. Problem number 1. Under that working note 1. Problem number 1. Under that working note 1. Working note 1. Calculation of working note 1. Calculation of cash price equivalent of the machine. Cash price equivalent of the machine. Okay, so year 0, 1, 2. Why 0? 0 means today. Year 0 means today. Year 1 means at the end of first year. Okay, at the beginning you call it 0. At the end you call it 1. So what is the installment paid? Amount paid 33 lakh 33,333. Then 33 lakh 33,333. Then 33 lakh 33,334. Total 10 crores. Total 10 crores. 10 crores or 1 crore? $10 million means 1 crore. Okay, so it is not 10 crores, it is 1 crore. Okay, now discount factors at 5.36%. First one is 1 only, because at the beginning, no, today only you are paying. Why will you calculate present value? Now, second year, how to calculate? 1 divided by 1.0536. 1 divided by, how am I calculating? 1 divided by 1.0536. Because 5.36%, no, you should not write 1.536. It will become 53%. You understand? See, if you are taking 8% in financial management, how you might have done? 1 divided by 1.08, that is 8%. If you take 1 divided by 1.8, it will become 80%. You understand? So what is the discount factor you got? 0.949, 0.949. Can someone tell me what is the discount factor for the next year? I need your participation. You need to calculate at the end of second year, what will be the present value? Just take your calculator, calculate and tell me. Okay, correct answer. Someone is saying 0.901 in the chat box. Correct answer. Gokul, correct answer. Nirmal, correct answer. Gaurav, correct answer. Very good. Okay, now multiply present value, discounted amounts, which is nothing but present value. Okay, so 33 lakh 33,333. Next one, 333 into 0.949. That comes to 31 lakh 63,333. 31 lakh 63,333. You understand? Next, 334 into 0.901. That comes to 30 lakhs 3,334. 30 lakhs 03,334. Plus, add all the three. It is exactly coming to 94 lakhs 99,999.9. So can I say 95 lakhs? So machine should be recognized with 95 lakh rupees of value. You understand? The machine should be recognized with 95 lakh rupees of value. This is working note. So is working note one clear? Is working note one clear? Write down journal entries in the books of. What is the name of company? Company name is not given. So we'll write just journal entries. Journal entries. Write the proforma, particulars, debit rupees, credit rupees. Okay, day 1/4/2011. What is the journal entry? Purchase journal entry you need to write. What is the purchase journal entry? Property, plant and equipment account debit 95 lakhs to on the day when you purchased the asset itself, you made one payment, no? How much? To cash account. How much you paid? 33 lakhs 33,333. 33 lakhs 33,333 to Y Limited account. This balance is the loan. 61 lakhs 66,667. 61 lakhs 66,667. Okay. That's it. This is the journal entry. Now tell me guys, how many of you understand this journal entry? Do you understand this journal entry? Hello, any doubts in this? If you have any doubt, ask me. Otherwise, I'll move further and there are 2-3 other entries to be passed that I'll show you. So in the chat box, let me know, shall I proceed? Hello, your participation please. Give me a hint whether you understand. Okay, no doubts. Yes, we can move on. Very good. Okay, now tell me what is the next step. So on 31/3/2012, that means at the end of the year, you are making a payment of 33 lakhs 33,333, no? So can I say Y Limited account debit to Y Limited is my, is it Y Limited? No, there is no X Limited, Y Limited. It is our assumption. So we'll write accounts payable. Oh, in my example, it is X Limited, Y Limited. So here we write accounts payable. Supplier. Accounts payable is 61, 66, 667. So at the end of the year, when I'm making payment, can I write accounts payable? Accounts payable debit 33,33,333 to bank account 33,33,333. So can I write this journal entry? The answer is no. This is wrong journal entry. Why 33,33,333 you are paying? So this part is correct. But the whole is not towards accounts payable for supply of machine. Some finance component is also there. No? Some finance component is also there. So you need to recognize that finance component also. How will we do that? Leave space for another one journal entry, some 5-6 lines you leave, and then prepare working note 2. Leave some place and write down working note 2. Statement showing calculation of finance cost, or you can write down interest expense. Statement showing calculation of finance cost or interest expense. How will we prepare year? Opening balance, we'll take opening balance. Interest at a rate of 5.36%. Interest at a rate of 5.36%. Installment amount. Okay, so principal amount. And then we write closing balance. Okay, year one, or you can write 1/4/2011. Opening balance is 95 lakhs. Correct? Huh? I don't need to pay any interest now because today I have paid an first installment of 33,333. So this full amount is towards principal amount only. 33,333. So what is the closing balance? 95 lakhs minus 33,333. So 61 lakhs 66,667. So for 1/4/2012, closing balance of previous year is my opening balance here, 61 lakhs 66,667. On that calculate 5.36% interest. So it is 3,30,533. 3,30,533. So how much I am paying? 33,33,333 installment I am paying now. In that installment, what is interest amount? 330,533. 333,333. So many threes are there. Be careful. Minus 3,30,533. So the balance is towards principal amount repayment. How much that is? 30,02,800. You understand? So this installment is divided into two parts. Part 1 is this. Part 2 is this. So in the journal entry, 33,33,333 blue color is there, no? That will come in the credit to bank. 33,33,333. In the debit, 3,30,533 will go to income statement because it is interest expense. It is interest expense. And the remaining 30,02,800 is there, no? This will reduce your liability. Now calculate the closing balance. Opening balance is 61, 66, 667. Opening balance is 61, 66, 667. Okay. Minus how much of your principal amount you have paid? 30 lakhs 0 to 800. That comes to 31 lakh 63,867. So next year 1/4/2013 opening balance will be 31 Hello. Hi. Sorry for the interruption. So, shall we continue? Sorry for the interruption. My power cable was not on, so the system got shut down with low battery. I'm sorry for that. So, we'll continue. Okay. So, at the beginning of third year, the opening balance due is whatever is the closing balance. What is the closing balance of previous year? 31, 63, 867. Is it right? 31, 63, 867. On that, calculate 5.36%. Calculate 5.36%. 31, 63, 867 into that comes to 1,69,583. 1,69,583. Then the balance is 29 lakhs 94. 29 lakhs 94 284. Is it right? No. Wait. Hello. Hold on. Installment is 333. Out of this, you have paid 169,583 towards interest minus 169,583 towards interest. So what is principal amount paid? 31,63,750. So the closing balance is 0. Now the difference between this and this is there. No, this is rounding of difference. This is a rounding of difference. So one better way of doing this is, even in ICAI study material also, they have done the same thing and they have shown the difference. So there is some 100 rupees odd difference is there. But the best thing what we can do is, installment, you know this, outstanding, you know this. So write interest as the balancing figure. Then that 0 will come and there will be no rounding of difference also. So what we can do is, we can correct this amount. How? So total 333 I am paying. Out of that 31,63,867 is the principal amount. So write 169,466 here. Happy? Now you will pass these journal entries above. That's all. Okay, now go back to your journal entries and write down second journal entry. Interest expense debit. Interest expense account, working note 2, debit. How much is interest expense as per our working note? 330, 533. 330, 533. Now accounts payable will not be this amount. Accounts payable, how much? 30,02, 800. Now look at the journal entry. Interest expense account debit 3,30,533. Accounts payable 30 lakhs 2,800. To bank 33, 333. You understand? Then the third journal entry 31, 3/2013. Same entry will come. Interest expense account debit. Accounts payable account debit to bank. To bank how much? 33, 333 or 4, whatever. Okay, interest expense kitna hai? 169,466. 169,467 it will be. 467. 1 rupee be increased now. 33, 334. So 1 rupee will be increased. So the balance is accounts payable. How much it is? 31,63,867. 31,63,837. Okay, these are the set of journal entries. 3 journal entries, simple. So now tell me, we completed solving this problem. The concept is when there is a deferred credit period beyond normal credit period. When there is a deferred credit period beyond normal credit period, then the cash equivalent price only can be recognized as an asset. The balance should be treated as interest expense. So every year need not say second year that interest expense 3,30,533 is there. No, that will be charged to your P&L. You will take that to P&L. In the P&L, you will write profit and loss account debit to interest expense. Profit and loss account debit to interest expense. That's all. You understand? So these are the three journal entries. Okay. Any doubts in this? So I am looking at the chat box. Guys, do you understand this or any doubts? Please tell me. So I am looking at the chat box. Are we connected, guys? Are you able to see me? Are you able to hear me? Sumit is saying no doubts. What about others? Sakshi said understood. Very good. So if this is given in the exam, you'll be able to solve. This will be given for 5 marks. If this is given in the exam, will you be able to solve? Yes, very good. That's nice. So shall we go back and start with the standard? Very good. Sakshi is saying yes, sir, we'll be able to solve. Gokul is asking, sir, can you please repeat why the capitalization 1 crore is reduced to 95 lakhs? Beta, the concept is simple. The machine is not worth 1 crore. The machine is not worth 1 crore. If you pay cash today, you will get it for 95 lakhs. But because you told your supplier that, Anna, I don't have money, I can pay you only after 2 years, I will pay only in this installments, please give me. Then he gave you asset at 1 crore. So the fair value of the asset is not 1 crore. The value of the asset is less than 1 crore. Because he is giving you in installments, the asset is inflated by him to 1 crore. So the actual value is 95 lakhs only. That is what we calculated. The present value is 95 lakhs only. So the asset will be recognized at its cash down price, which is nothing but the present value of future cash flows, and the balance will be treated as interest expense. This is the concept. Gokul, you understand it now? Understood. Thank you. Very good. Superb. Okay, normally, any lecturer dealing with any subject, first they go with the theory and then they will take you to problems. But first we have done one problem, now we are coming back to theory, because too much of theory you will be confused. Point number 1. Point number 2, at the end of the day in the exam they will never ask you theory, no, they will ask you application of theory. So that is the reason what I do is you should understand the concept and you should be able to solve the problem simultaneously. That is the reason first day, first session, I started with a problem so that some activity will be there. Otherwise morning 6 o'clock you wake up, you put your tab in front of your face and then you sleep on that. That is the reason. So chalo, let us go back to basics and understand some theory. Scope. Every accounting standard will set out some scope. That means what are the inclusions, what are the exclusions, what are the inclusions and what are the exclusions. So in this standard also they are saying The standard shall be applied. The standard does not apply. See the 2 bullet points. Under the scope, first point they said the standard shall apply. Second point, the standard shall not apply. So what is the first point? Shall be applied in accounting for PPE except when another standard requires or permits a different accounting treatment. That means another special standard said treat it like this, then we'll follow the other standard. If no other standard is there specifically for this asset, in general, property, plant and equipment shall be dealt with, shall be accounted for as per this accounting standard. What are the exclusions? PPE classified as held for sale. One beautiful thing is, asset held for sale, there is no specific accounting treatment in accounting standard 10. Accounting standard 10 was silent. Say for example, I have a machine, okay, this is my machine, this is worth 1 crore, imagine. When I am continuing this accounting standard is 10 applies. Why? Because as per the accounting standard, what is a property, plant and equipment? What is a fixed asset? A fixed asset is an asset which is held for use. Which is held for use. Till I use this in my factory, this fixed asset. But today I decided I will sell this off. So I have given advertisement in newspaper, property for sale. So now this fixed asset has become fixed asset ready for sale or available for sale, or you are holding it for selling it. So normal accounting standard cannot be applied. You understand why normal accounting standard cannot be applied? Simple. It failed the definition. No, if it complies with the definition, then the standard is applicable. What is the definition? Fixed assets are the assets held for use, not assets held for sale. Now, when I keep this for sale, it lost its identity as a fixed asset. The good news is in new generation accounting standards, there is a standard for assets held for sale, that is 105. So obviously, when property, plant and equipment which is held for sale has another accounting standard, 16 is not applicable. Then agriculture, Ind AS 41, biological assets relating to agricultural activity other than bearer plant. Now imagine there is some mango farm, mangroves. So you have 10 acres of land. In the 10 acres you have put mango trees. So your intention is one fine day mangoes will come. That day I'll harvest and I'll sell it. So here you have to understand 4 things. One is you have a land. Land is PPE, property, plant and equipment. Then you have mango trees whose life is more than 1 year. Mango tree can live for 5 years, 10 years, 20 years, 30 years. No, your intention is never to cut the mango tree and sell. So the agricultural produce, mangoes will come when you harvest mangoes. No, that is inventory. That you sell. Mango you sell. Mango tree you will not cut. So mango tree is there. No, that is like machine. So you will not sell the machine. You will produce, some product using the machine and you sell the produce. Same concept here. Same concept here. So the mango tree is our property, plant and equipment. That mango when you harvest, that is your inventory. You understand? So they are saying biological assets other than bearer plant. Bearer plant. What is bearer plant? We'll study. What is biological asset? Biological asset is any living, plant or animal. Biological assets other than bearer plants, this standard will not apply. That means for bearer plant, this standard will apply. For bearer plant means a tree, a plant which bears a fruit for more than 1 year. So, Pavan sir, how will we deal with biological assets? Ind AS 41, agriculture. Separate accounting standard is there for agriculture. I was conducting, one of my friends is conducting audit of one bird sanctuary. Birds and all will be there, no? Can you believe we apply, Ind AS 41 in some of the areas of the audit? Agriculture, biological assets. Then, third one, recognition and measurement of exploration and evaluation assets. What is this? Legal rights for mining. So you have obtained one license from the government and you started extracting, excavation, exploration of oil. This standard is not applicable to you. Even if you remember, accounting standard 10 also said for mining rights and exploration assets, AS10 is not applicable. So in the old accounting standard system, there is no separate accounting for this. There was a guidance note. But in the new generation accounting standards, there is a separate accounting for this exploration and evaluation assets. That means mining rights. That is 106. So this accounting standard is not applicable. Then mineral rights, mineral reserves such as oil, natural gas, similar non-regenerative resources. This is not applicable. They have separate guidance. They have separate standard. So these four, it is not applicable. Pavan sir, what if I am using a tractor in my mango farm? I am using a tractor. Can I apply accounting standard 10 to that, or should I apply agriculture standard? Are you kidding? Tractor is PPE only, no? So what they're saying, however, this standard applies to property, plant and equipment used to develop BCD. So B is their biological asset, C is their recognition measurement, D is their mineral rights. So in your mining, you have one truck, you have one lorry, that is PPE only. In your mango garden, you have a tractor, that is PPE only. That is what they're saying. Okay, then they're speaking something about investment property that we'll see in Ind AS 40. So basic theory, this standard is applicable to, this standard is not applicable to. That's all. Then definitions. We'll see property, plant and equipment definition. In your notebook, write down. In your notebook, write down. Definition. Under that, PPE, property, plant and equipment are tangible items. PPE are tangible items. Property, plant and equipment are tangible items. Definition, PPE are property, plant and equipment are tangible. If it is intangible, beta, you have another accounting standard waiting for you, 38, don't come here. 16 is only for, Ind AS 16 is only for tangible items. Property, plant and equipment are tangible items. Tangible items, comma, that are held for, three purposes, that are held for use in the production or supply, of goods or services. Two, for rental income, rental to others. You bought an asset, you are giving it on rent. That is your asset only, no? For administrative purposes. Second one, expected to be used for more than one period. Expected to be used for more than one period. This is the definition of PPE. Okay, under that, write down question number 1. Question number 1. Question number 1. Under that Question number 1. X Limited acquired 5 delivery vans. X Limited acquired 5 delivery vans which are expected to be used in supply of finished goods to customers. X Limited acquired 5 delivery vans which are expected to be used in supply of finished goods to customers. Whether delivery vans constitute items of property, plant and equipment. Delivery vans constitute items of property, plant and equipment. Guys, read this and tell me answer, please. I'm waiting for your answer. Tell me fast. What is your answer? Pragati saying yes, it is PPE. What about others? Everybody saying yes. Yes. Why? Because as per the definition, any asset that is used in the production or supply of goods and services, okay, then it is item of PPE. Another condition it has to satisfy is more than 1 period. Obviously, when you are purchasing a truck or a delivery van, you'll use it for more than 1 year. No? So yes. Yes. Question number 1. Now question number 2. Question number 2. Y Limited is a pharma company. Y Limited is a pharma company. They have installed pollution control equipment worth rupees 5 crores in one of company's factory. They've installed pollution control equipment worth rupees 5 crores in one of their factories. Is pollution control equipment an item of property, plant and equipment? Is pollution control equipment an item of property, plant and equipment? Guys, tell me the answer, yes or no? I'm getting answers. Sumit is saying yes, Pragati is saying yes. What about others? Yes. Everybody is saying yes. Now try to understand the word administrative purpose. The word administrative purpose includes all these kind of pollution control equipments, marketing, sales, everything comes under administration only. This administration is not like your cost sheet. Pavan sir, in cost sheet, administration, marketing, beta, it is not that one, okay. Administration means in general, if you are using it in the business, you can categorize this. The answer is yes. Okay, then question number 3. Question number 3. Z Limited, write down. Z Limited is engaged in the business of giving diesel generator sets. DG is diesel generator power backups. Z Limited is engaged in the business of giving diesel generator sets on rent to various third parties, to various customers. They have 25 DG sets used in such business. Can DG sets be classified as PPE? This is the question. Answer below. Yes. Right on. The answer is yes. Now write down one very important point. Conversion of items of PPE, into inventory. Conversion of items of PPE into inventory. Put a star mark. In the above example, if the entity Z Limited is engaged in the business of giving DG on rentals and also sale of new and second hand DG sets. So they'll give DG generator sets on rental income, and if you want, they will sell also. If you want, they will sell second hand DG generator sets also. Second hand DG sets. During the year, 10 DG sets which are used for rental income so far. During the year, 10 DG sets which are used for rental income so far are classified as inventory and held for sale as second hand DG sets. What is the accounting treatment? Note it as very important point. Very important question. Note it as important question. Tell me what it is. Hello. I am asking you, waiting for your answer. No answer. So I'll write one journal entry here. You tell me whether it is correct journal entry or not. Someone is saying that WDV of the asset will be transferred to inventory account. Correct. So can I pass a journal entry like this? Inventory account debit. Inventory account debit to PP. Is this correct? Some student is saying, no, it is not correct. So can I pass the journal entry, inventory account debit to PP account? One student is saying no. What about others? Can I pass a journal entry, inventory account debit to property, plant and equipment account? Hello, your response. Unless you participate, how will you understand concepts? So I have got one no, I have got two no's, I have got three no's. No, 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 everywhere. Any response from others? Anyone who says this journal entry is correct? So Sumit, Shreyas and Pragati, you are saying no. Can you tell me what is the correct journal entry then? If I should not pass inventory account debit to PPA, can you tell me what will be the correct journal entry? This journal entry is correct or wrong? This is correct journal entry. And the amount should be the carrying amount. The amount should be carrying amount of PPE in the books of the company. What is carrying amount? WDV. So whatever the WDV is there, the WDV from your books, you will take it into inventory. That's all. Book entry, inventory account debit to PPE. This is correct answer. Copy this. So are we done? Can we move to next one? One student is asking, sir, in this case, why can't we use another standard which says non-current asset held for sale? Now better listen. This is no more non-current asset for you. This is current asset for you now. See, I have a building. I want to sell the building. It's a different situation. When I am putting 25 buildings into business of selling, that will become inventory, no? Here the point is, you have 10 diesel generator sets. Till today, you are using that as property, plant and equipment. You are using that for rental income. From today, you kept the 10 diesel generator sets in your showroom and said these are held for second sale. So that has become your inventory now. It is no more non-current asset. It has become current asset now. That is the reason that standard is not applicable. Inventory standard is applicable. Kushi, you understand the point? You asked why can't we use 105? We cannot use 105 because you are classifying them into inventory for sale. It is not non-current asset held for sale. It has become current asset held for sale. Is that clear, ma? Can we go to next question? Okay, understood. Very good. So write down next question. Very, 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 very important question again. Very important question. One student is asking, then every year on year, the value of inventory will change, right? The closing inventory will not be the same as opening inventory. Yeah, obviously it will not be. Yes, correct. Every year on year, the value will change. Okay. Now look here. X Limited purchased a machine whose price is 100 lakhs. In consideration, they issued 1 lakh equity shares of rupees 10 each. The market price of each equity share is rupees 80. The market price of each equity share is rupees 80. How the purchase of machine is to be recorded in the books. Tell me the journal entry is to be recorded in the books of account. So one student is asking, then when we transfer the asset into inventory, where the value of inventory is more than the market value of the asset, हो सकता है, Pragati, it is possible. In market, say for example, second-hand diesel generator set is say 1 lakh rupees. But in your books, the carrying amount is 1 lakh 10,000. You will take 1 lakh 10,000 only to inventory. When you sell the asset, profit or loss will be determined. No, when you sell the DG set, profit or loss will be determined. Or if you say, Pavan sir, I am not able to sell the diesel generator set up to 31st March, that is where there with me only, then you will do year-end inventory valuation. Then the adjustment will be charged to P&L as loss. On the date of classification, you will not revalue. On the date of classification, you will take the cost only. Subsequently, either on the date of sale of inventory or on the date of balance sheet when you are valuing inventory, then the loss will be booked. Pragati, you understand ma? You asked one doubt. Okay, very good. Good. Okay, so what is the journal entry? Someone is saying machine to equity share capital 10 lakhs. So 100 lakhs, dude. What 10 lakhs? Sumit is saying machine account debit to equity. Okay. Okay. So everybody is saying machine account debit to. So tell me one thing. Can I say machine account debit? How much I should write here? Machine account debit, how much I should write here? In the box, tell me how much I should write. $100 lakhs, 100 lakhs. Gokul is saying 80. Ritik is saying 100. Nirmal is saying 80. 100. Nirmal is saying Shreyas 100. Anjana, Shanmukapriya, Sumit. Everybody is saying 100. Okay. Kushi is saying 80. Okay. Chalo. If I write 100 here, if I write 100 here, correct or wrong, that we'll see later. If I write 100 here, to share capital I write, to equity share capital, how much? 1 lakh shares into 10 rupees. So 10 lakhs here. To security premium. 1 lakh shares into, how much should I write here security premium? Shanmuko Priya is saying 70 lakhs. Okay, 1 into 70. So imagine if I write 70 here, the balance is not tallying, the debits and credits are not tallying. So what should I do? What should I do? Tell me. Hello, what should I write with remaining 20 lakhs? Shall I take it to P&L account? To P&L account 20. Some students told this answer also. Sir, recognize profit. I'm like, seriously, you're issuing shares, purchasing machine, recognizing P&L. So beta, ye galat hai. This cannot be 100. Ding, ding, ding. This has to be 80. This journal entry is correct. You understand? Now remember the rule. Pass the journal entry and remember the rule. Fair value of, see, in case of a machine purchased, in case of a machine purchased, and consideration paid through a non-monetary asset or a combination of cash plus non-monetary asset. Classic example, for example, exchange of old asset with new asset. For example, exchange of old asset with new asset. Exchange of old asset with new asset. The amount at which the new asset is to be recognized in books is, fill in the blank, dash. The amount at which the new asset is to be recognized in the books is. Read the full sentence, fill in the blank. I'm waiting for your answer. In case of a machine purchased and a consideration paid through non-monetary asset or a combination of monetary and non-monetary assets. Cash you have given plus exchange of some other asset. The amount at which the new asset is to be recognized in the books is dash. Someone is saying market value of the old asset. Okay, I give you one option. 1. Fair value of asset purchased. Fair value of asset purchased. 2. Fair value of asset given. Fair value of asset given plus or minus cash. I have given old asset and I have given 10 rupees. Or I have given old asset, I got new asset and I got 25 rupees. Cash adjustment. Or 3. Book value of old asset. Someone is saying fair value of the exchanged asset. So which one is the correct answer? 1 or 2 or 3? I have given 3 options. What is the correct value? Should I take 1, fair value of asset taken, 2, fair value of asset given, 3, book value of asset? Everybody is saying option 2. So this is correct. Fair value of asset given plus cash is correct. If it is not available, if 2 is not available, then 1. If both 1 and 2 are not available, then 3. If 2 is available, first option is we look for fair value of the asset given plus or minus cash. If that is not available, then fair value of the asset purchased. If both 1 and 2 are not available, then we go to 3. But when you read the standard, they say 1 and 2, whichever is clearly evident. What is this? 1 or 2, whichever is clearly evident, whichever is clearly available in the market. So I give you two examples. Example 1. Example 1. New Maruti car purchased. New Maruti car purchased. Shares of a listed public company. Shares of a listed public company given. Shares of a listed public company given. So what is new Maruti car? New Maruti car value is, say for example, 5 lakhs. Shares of listed public company given, no, it is 4.8 lakhs. Now tell me, what is the journal entry? Journal entry is property, plant and equipment, in bracket Maruti car, debit, to shares in Infosys account. Say for example, you are giving Infosys shares to them. You are possessing Infosys shares, you are giving Infosys shares to them. So what is the fair market value of Maruti car? 5 lakhs. What is the fair market value of this Infosys shares given? 4.8 lakhs. So what should I write here? Should I write 4.8 now in the journal entry or 5? Tell me, should I write 4.8 in the journal entry or 5 lakhs? Fast, fast, fast. Gaurav is saying 5. So I am getting 4.8, 5, 5, 4.8, 5.8, 4, 5, 4.8. The answer is 4.8 correct. First preference to consideration given fair value. First preference to the fair value of the consideration given. You understand? You understand? Next, second example. Example 2. Example 2. Old Maruti car purchased. Value not available. Value not available. Shares of Infosys given, worth 2.5 lakhs. Shares of Infosys given, worth 2.5 lakhs. What is the journal entry? Property, plant and equipment, old Maruti car, 2.5, debit, to investment in shares of Infosys. Investment in shares of Infosys. This is my investment now. Now I am giving it away. Infosys shares 2.5. This is easy. There is no confusion. What if, look at example 3. Example 3. Old Maruti car bought. Old Maruti car bought. Value rupees 2.6 lakhs. Infosys shares given. In consideration, Infosys shares given is 2.7 lakhs. Infosys shares given 2.7 lakhs. Okay, but you are not sure about the old car valuation because this valuation is done by one mechanic. There is no valuation certificate. So this is clearly available. This is not clearly available. Valuation of old car is done by one mechanic roadside. Infosys valuation is done by BSc, NSc, no? Like, the market quoted price you have taken. So this is more evident. So you'll write the journal entry, PPE account debit, new old Maruti car account debit to investment in the shares of Infosys. You'll write 2.7 because 2.7 is more clearly evident. Now imagine if, or I'll write another example. Okay, I'll write another example. Old Maruti car bought. Old Maruti car bought shares in XYZ private limited company given. You have shares of XYZ private limited company. You went to a person who has a Maruti car. You negotiated with him, hey, please give this your Maruti second-hand car to me. I will buy, and in consideration, I will pay you X number of shares in some number of shares in XYZ private limited company. He agreed. He agreed. What is the fair value of Maruti car? You don't know. What is the fair value of XYZ private limited company shares? You don't know because valuation is not available. Now, how will you pass the journal entry? So, one situation is old, new, fair value. Old fair value available, new fair value available. Old machine fair value available, new machine fair value available. So, take old fair value. This is one situation. In second situation, so here I write this will text. What is the second situation? My second situation is old fair value not available, new fair value available. Then go ahead with this. Another situation, old fair value not available, new fair value also not available. Then you go with, in this situation, book value of old asset. Book value of old asset. This is how you should write. You understand this? Now write down the principle. In case of exchange of exchange of an old asset for a new asset. In case of exchange of an old asset for a new asset, comma, the new asset shall be recognized in the books at a fair value of old asset given plus or minus cash adjustment. Fair value of old asset given plus or minus cash adjustment, or B, fair value of new asset acquired taken. A or B, whichever is clearly evident. But always remember, priority should be given to A. Remember to give priority to A. You understand? Then point number 2. This is point number 1. This is point number 1. Now point number 2. In a rare situation where the fair value of asset taken and the fair value of asset given, comma, both are not available. Both are not available. In a rare situation where the fair value of asset taken, fair value of asset given, both of them are not available, then the value of new asset, then the value of new asset, the value of new asset is equal to the book value of old asset. The value of new asset is equal to book value of old asset. Next very important point 3. In case of exchange of assets, in case of exchange of assets, in case of exchange of assets that lack commercial substance, in case of exchange of assets that lack commercial substance, comma, the new asset should be recorded with the book value of old asset. In case of exchange of assets that lack commercial substance, underline. The new asset should be recorded with the book value of old asset. New asset should be recorded with the book value of old asset. Pavan sir, what is this? Now imagine you and I are friends. Imagine you and I are friends. Okay, I have one Honda City car. I have one Honda City car. Okay, you have one, say, Verna car. Hyundai Verna. I am using my car for 4 years. You are using your car for 5 years. I am using my car for 4 years. You are using your car for 5 years. One fine day we met and I said, hey, wow, your car is looking too good. You said, bore ho gaya yaar. For the last 4 years, I'm using this car. Nice car, but I'm not enjoying it now. Then you drove my car and you said that, hey, Honda car is looking amazing, dude. Then we have got one idea. Chalo, ek kaam karte hai. Take this keys, give your keys. So today I have Honda City. From tomorrow, I'll have Hyundai Verna. Imagine we are friends for 6 months, 1 year we use. After that, we'll swap the cars again, or we'll register the cars also, and I will be selling the Hyundai Verna in future, not Honda City. So I am owning it. Registration is also done, exchange. Whether we are friends using car, swapping car and using it, or we registered also. So I said, from today, this Honda car is yours, registered. You said, from today, Pavan, my Hyundai Verna is yours. Le lo, register. Now, if I am writing journal entry for this in my books, what will I write? I will write Verna car account debit to Honda City car. So this Honda City car in my books, it is appearing as 5 lakhs. So I'll write the journal entry with 5 lakhs, 5 lakhs. So new car is recognized, old car is de-recognized. What is the amount passed in the journal entry? Book value of the old asset. When the exchange of assets is not having a commercial substance. Pavan sir, what is the meaning of commercial substance? Future economic benefits or the cash flows will not change. So whether I use Honda City or I use Verna, my value in use will be same, my economic benefits will be same, and my cash flows are not affected. Then we call it transaction having no commercial substance. Remember one thing, simple basic logic. Do not recognize any profit or loss on this transaction. What is the intention? Don't recognize any profit or loss on this transaction. How it is possible? It is possible only when you pass this journal entry. When you pass this journal entry, there is no profit, no loss. Why? Because there is no commercial substance. For namesake, you have to pass a journal entry, but there is no effect on your business. There is no effect on future economic benefits. There is no effect on your cash flows. Then you write this journal entry. You understand? Important it is. Okay. Now another note, very very important note. Another very 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 important. Any situation, I repeat, any situation. It could be in the event of amalgamation. It could be sale of asset. It could be sale of business. It could be exchange. It could be any transaction, any situation when an asset is sold. Any situation when an asset is sold. It could be your transfer or in case of amalgamation. Your transfer or in case of amalgamation in the nature of purchase. Your transfer or in case of amalgamation in the nature of merger. You are selling the asset. Any situation when you sell the asset, when the asset is sold, the amount that should be credited. So when you sell the asset account will be credited, no? When you sell the asset account will be credited. So what is the amount that should be credited? The amount is always book value. Sometimes students will be confused. Pavan sir, should I take book value or market value or fair value, or which value should I take? Better always book value. Always book value. Pavan sir, why? Remember the simple logic. If you are not crediting the asset with book value, ledger account of this asset will not be closed. So my objective is I want to close the ledger account of this asset. Why? This asset I sold. So I sold this asset. When I sold this asset, why this asset ledger account is there in my books? That should be closed now. How can I close the ledger account? Just by reversing the debit. Whatever is appearing in the debit, I will reverse it and I put it in the credit. Balance goes to P&L. Profit, P&L. Loss, P&L. So always remember, whenever you sell the asset ledger account should be credited with the book value existing in your book. This is very, 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 very important, because when you exchange an asset in the above example, old asset might have been exchanged at a profit. You need to take that to your P&L account. Imagine book value is 2 lakhs, but it is exchanged at 3 lakhs. When you pass the journal entry, you need to record 1 lakh rupees of profit also. This is very important. Sometimes students will miss this. So remember, any situation when you are selling any asset, that should be credited with the book value only. Balance will go to P&L. Is this clear? So shall we solve one problem on this? In case of exchange, we are taking fair value of asset given. Then how should we recognize the difference between fair value book value? Profit, ma. Kushi profit. 2 lakh rupees book value asset, fair value 3 lakhs. I have exchanged it for 3 lakhs. That means I sold the asset at 1 lakh profit, no? Kushi, you understand it? Book value of your old asset is 2 lakhs. You exchanged it at a fair value of 3 lakhs. That means effectively you sold it at 1 lakh profit. That is what I am explaining now. You are buying an asset. When you are buying an asset, fair value of the asset taken is irrelevant. First question you asked is fair value of asset given. Fair, see, simple. Imagine one thing. Kushi is selling this mobile to Pavan at 5,000 rupees. Kushi is selling this mobile to Pavan at 5,000 rupees. Pavan bought this at 5,000. Pavan bought this at 5,000. Market value 7,000. Kushi sold this mobile to Pavan at 5,000. What is the market value of this one? 7,000. In my books, I'll write the journal entry for 5,000 only, no? Why? I paid 5,000. So, new mobile, I bought this new mobile or second-hand mobile account debit 5,000 to cash 5,000. So, fair value of the asset purchased is irrelevant if you know consideration. You got the clarity, ma? Is it clear now? Is it clear? Do you have any doubts still? We'll solve 1, 2. Very good. Good that you understand. I'm glad. So we'll do 1, 2 problems, then you understand it properly. So before we close the day today, we'll do 1 more problem. Okay, open your textbook, problem number 2. Problem number 2. Look here. Pluto Limited owns land and building which are carried in its balance sheet at an aggregate carrying amount of 10 million. Okay. Pluto Limited owns land and building which are carried in its balance sheet at an aggregate carrying amount of 10 million. The fair value of asset is 15 million. Exchanges the land. The company exchanges the land and building for a private jet. They bought a private jet which has a fair value of 20 million. And the company pays additional 3 million in cash. Show the necessary treatment as per Ind AS 16. This question straight can come in your exam for 2 months or 3 months. They might ask you this question for 2 months. Okay, so take 1 minute of time, read the question again. Can you tell me what is the journal entry you have to pass? Take 1 minute of time. Don't take more time. So I want answer. I want your answer. Old asset. Book value 10 million. Old asset. Fair value 15 million. New asset. Fair value. New asset fair value कितना है? 20 million. New asset fair value 20 million. Cash paid 3 million. Cash paid 3 million. Gokul, just now I told you, any situation asset sold, the asset should be credited with its book value only. Balance should go to P&L. I am shouting like anything. If you pass that journal entry, better you will lose 2 marks. Where is the profit recognition? In your books, land and building is shown at 10 million now. If you show it, if you reverse it at 15 million, don't you think in land and building account, credit 5 will appear? What is that credit in land and building account? Ridiculous. Gaurav is saying record private jet at 23 million. Right, right. Till now, what I have explained and what kind of answers you are giving. Private jet 18, cash 3, land and building 15. No one is recognizing the profit on sale of land. 10 million worth book value land, you agreed to sell at 15 million. That means there is a profit. P&L 7. Pragati, how P&L 7? New asset 22, old asset 10. To cash. No. Ritik is saying private jet 18. Sakshi is saying new asset 18, old asset 10, cash 3, P&L 5. We can pass another entry to recognize. No, why you want to write another entry? When you can complete everything in one entry, why you want another entry? Okay, see, look here. Property, plant and equipment, new asset, private jet. Debit. See, in the standard, what we are doing, we are discussing this. Okay, we are discussing that yellow color shade is there, no? That is what I want. How much I need to put there, I don't know. To land and building. Always take book value 10. Why? Because I am selling it, I need to cancel it. In my books, I need to remove it. 2. Profit on sale of land, gain on sale of land. 5 million. How? 10 million book value, you are agreeing at 15 million, no? So 15 million minus 10 million is equal to 5 million. This is profit. 2. Cash you have paid. Right? So cash you have paid, write down the journal entry. Cash you have paid. How much you have paid? 3. So to cash 3. Now tell me in jet account how much will appear? So first you have written PPA. PPA. To land and building 10. To P&L 5. To cash 3. So obviously now jet will be recognized at 18. Jet will be recognized at 18. Now you go back to your notes. What did I tell you? In case of exchange. What did I tell you? In case of exchange. The cost of the new asset to be recorded is the fair value of the old asset plus or minus cash. That is the principle I have explained already. Same thing we are doing in this. So finally, what is the journal entry? The journal entry is, look here, new asset 18, to old asset 10, to cash 3, to profit on sale of old asset 5. So you understand this? All of you, please let me know in the chat box. Do you understand this? If you understand, type yes. Very good. I'm happy that you understand. So you understand the exchange. So what is the summary? Tell me. Summary, tell me. So close your eyes, visualize, and try to recap. In case of exchange of an asset, fair value of the old asset given, plus or minus cash is the value of new asset. Fair value of the old asset given plus or minus cash is the cost of the new asset. Step 1. Step 2. When you are exchanging the old asset, difference between its fair value and book value will be profit or loss. When you are exchanging old asset, the difference between fair value and book value constitute profit or loss. If fair value of old asset is not available, then you can record from the point of view of fair value of new asset. If both fair value of old asset and fair value of new asset are not available, then you take the book value of the old asset. When the exchange is lacking commercial substance, then record the journal entry with the old asset book value. That is all. So you understand it? Any doubts in this? So with this, we have completed today's session, and shall we start the balance with tomorrow? Balance accounting standard tomorrow. So probably we might be closing down this Ind AS 16 tomorrow, and then we'll go to intangible assets. Okay. So guys, any doubts before we move on? Before we call it the day, any doubts? Sumit is saying no, sir. See, initially, because today only I started classes, I'm little slow and we are doing more workings. This is warm up, okay? 4 or 5 days classes will be like this, 4 or 5 days. After that, you will see the real CA final. We are doing only warm up exercise, okay? All of a sudden, I cannot give body pains to you. So this is first day of gym now. 2 or 3 days, warm up will be there. After that, we'll go to the actual CA final. Okay? Chalo, then see you tomorrow morning, 6:15. Okay? Have a nice day. Bye. When will asset given for rental will be recognized as lease transaction? That we'll discuss in lease, ma. Gaurav, that we'll discuss in leases. Okay. Chalo, take care. Have a good day. Bye.